Home prices had been steadily rising for some time. However, the Federal Reserve raising interest rates to combat inflation, housing prices are beginning to fall. Not only that, but home builders are halting construction. Here are the current mortgage rates as well as the impact higher interest rates have on the housing industry as a whole. Mortgage rates as of today. The mortgage rate for a 30-year fixed mortgage was 7.05%. As of October 14th, a slight decrease from a high of 7.10% the previous week. The 15-year fixed rate is 6.24%, while the 5/1 adjustable rate mortgage is 5.34%. The last time the fixed rate exceeded 6% was in November 2008, and I remember because I had a mortgage at 6%. And in order to slow inflation, the Federal Reserve raised the federal funds rate several times in 2022. As a result of these increases, banks also raised mortgage interest rates. But mortgage rates vary by bank, but for the foreseeable future, you can expect to pay around 7% on a 30-year fixed mortgage. Where are interest rates going? Well, mortgage interest rates are expected to remain high through October 2022 and possibly rise even further. The next Federal Reserve meeting is in November 2022, but it is unclear whether the board will raise interest rates again at that time. Current forecasts predict an increase in the federal funds rate, which is currently set between 3 and 3.25%. It could reach 4.4% by the end of 2022 and then rise further in 2023, possibly reaching 4.6%. The effect of higher interest rates on housing prices. We all know the Federal Reserve kept interest rates historically low for many years. As a result, you may be able to borrow money at a very low interest rate. This cheap money aided the growth of housing market, the pandemic, which saw people fleeing major cities out of fear, and because they could now work from home, also fueled the fire. Additionally, lockdowns caused problems with the supply chain, which made it very challenging for home builders to construct new homes. Why? Because when a low housing supply, high consumer demand, and affordable borrowing costs come together, housing prices soar. Higher interest rates are a significant factor. Like just last year, a 30-year fixed loan can have a 3.5% interest rate. Before, if you get a home price of $440,000 with 20% down, it will give you a monthly principal and interest payment of roughly $1,500 a month. With the same numbers and the current interest rate of 7.05%, the monthly payment comes to about $2,350. And we all know that the exciting part, you'll pay $770 more per month. That's a heck of an increase for just a year. And as properties stay on the market longer, sellers are starting to lower their asking price, meaning it is reasonable to assume that the slowdown will persist as interest rates rise. What effect higher interest rates have on bank stocks? The banking industry benefits from higher interest rates because lending institutions can charge a higher interest rate on the money they lend. On the other hand, some financial products like fixed rate mortgages are probably going to see a decline in demand as fewer people can afford the monthly payment. Instead, in order to make lower monthly payments, home buyers might choose adjustable rate mortgages with shorter terms in the hopes that interest rates will be lower than they are now in a few years. But of course, both individuals and businesses still need to borrow money to pay for necessities and fund their projects. Due to the higher interest rates, some people may borrow less money than they did previously, but they still borrow nonetheless. So banks continue to make money, and this boosts the value of their stocks. This is not to say that the bank stocks will be immune to market declines or even a recession, but because they are making more money from loans with higher interest rates, they should be able to weather the storm better. Rising interest rates from home builders, unlike banks, suffer during times of high interest rates unless they also offer mortgage financing or partnerships with a lender. Home builders borrow money to buy plots of land they need to build on, as well as building materials and labor. They get lower interest rates on their loans because they pay them off faster. This increases their profitability because the cost of borrowing is low. Higher construction loan interest rates have an effect on a home builder's profitability and sales. Pre-construction orders and sales are down, finished unit sales are slowing, and the monthly payment for a finished home is rising. As a result, the price is now out of reach for buyers who could afford the payment prior to the interest rate increase. Fewer home sales make it more difficult for the home builder to repay their loan, forcing the builder to divert funds from other areas of the business. And because of the decline in consumer purchasing power, a home builder with losses and reduced operating income is likely to see its stock value fall. Projects are frequently abandoned and home builders are forced to restructure in order to survive until interest rates fall again. The housing industry accounts for a sizable portion of the U.S. economy. With interest rates rising, home prices are likely to cool and fall. The impact on industries related to the housing market will vary. Some industries, such as bank stocks, should stack up well as the housing market swings. However, home builders may face a difficult winter and spring. Diversification is your best option as an investor to reduce risk. Alright guys, so thanks so much for watching my video. As usual, leave a comment, give me a like, and let me know in the comments if you want to see any other videos. Nonetheless, hope you enjoyed it, and I'll see you in the next video.